Matt Orton is Chief Market Strategist at Raymond James Investment. He's joining us now. Matt, good to have you with us here. Good morning. What is the latest? And the market overnight was closed, but what's the latest on this debt thing? Debt ceiling.
Hey, good morning.
It'll be put to a vote. Do you expect it to pass without a hitch?
Good morning, Prashant. And it'll be interesting. I mean, there can always be drama in the Senate and the House, but I fully expect to see a deal pass. No politician besides the few that have already drawn lines in the sand want to be the reason why the U.S. goes into an economic catastrophe by defaulting on its debt. So it's highly unlikely we see any fireworks. It's going to be nice to move past the distraction of the debt ceiling. Friday market action, a lot of it was already priced in. It seems like the impact to the overall economy is going to be fairly benign. So that's definitely encouraging as well. And I think what this finally allows investors to do is refocus on the economic data that's been coming in, which has been stronger than expected. And it also puts all the focus on the Fed and the incoming data we have this week. We've got jobs report on Friday. If we continue to see robust jobs growth in the U.S., that continues to put pressure on the Federal Reserve. It's not my expectation.
There is one narrative, Matt, that, the pricing pressures that we're seeing currently will swing from inflationary to deflationary towards the end of 2023, purely because of, the unwinding of the pricing spikes that we saw that were caused by supply constraints. Okay, we'll get back to Matt in a bit. I think, we lost that audio with him. But that seems to be the narrative, that if the pricing pressure swings from inflationary to deflationary, then there'll come a point when rate cuts could be announced by the Fed, and perhaps the market is pricing that in. Okay, Matt, welcome back. I think we lost you for a second. But are you at any point in time over the next 6 months looking at the start of a rate cutting cycle from the Fed? And if you are, then is this a great time to be topping up on equities?
So I think within the next 6 months, the Fed's going to be hard-pressed to cut interest rates because the rest of this year, the economic outlook still looks pretty positive. My base case has always been a scenario of rolling recessions through the economy, where different sectors and industries are going to feel the impacts at very, very different and lagging times. And we're seeing that play out a little bit right now. But in order for the Fed to cut rates, you've got to see the tightness of the job market ease. We're not seeing that conclusively. Inflation is certainly coming down, but there's persistent pressures. The housing market hasn't cratered. I think there's structural supply and demand imbalances that have led to that. And as a result, the Fed's going to have to keep its foot on the brake for a little while longer. And until you really start to see that more severe weakness come through, or conclusively that we're on the path towards 2.5% inflation, it's going to be hard for the Fed to cut. So my base case is later in the first half of 2024 is when we might start to see the first rate cuts.
Hi, Matt. Good morning. The last time we chatted, I think you were in minority. Now it appears most on the street are indicating that we'd like to see another rate hike. And maybe, in fact, the cuts come only in 2024. So it appears you're getting that call right as of now. But let's focus on markets and Asian markets ex-China. You like quite a few of those. Tell us, where does India come in? Because I'm just going through your note. You like markets like Taiwan, Korea, Philippines, Indonesia as well. When does India come in the pecking order? Valuation-wise, are we still too expensive for you to go all out?
Yeah, Nigel, we talked about this the past few times that I've been on, and I've been getting progressively more bullish on India because the fundamentals are there. Earnings have largely been positive, and we've seen continued strength through some key parts of the overall economy. And I think over the past month, what's really most encouraging about the rally that we've seen is that it's broad-based. It's happening across cyclicals and some more secular growth pockets of the market. So you're seeing banks, you're seeing even information technology. I hadn't been that positive on IT and IT services, and we've seen bottom. We've seen a lot of those companies coming out of consolidation, and that's encouraging to me. So India is moving up pretty close to the top. I would tell investors right now to use any downside a little bit more opportunistically. We're heading towards breaking through, the December highs of last year. And if you do that conclusively, I think you'll continue to see some more upside. But I would be careful about maybe dollar cost averaging your way in, not chasing the market higher and picking your places. But I still like Asia ex-China as well. So Taiwan, South Korea are benefiting from the AI trends. Semiconductors have done well. but banks in those countries have also done well. The dollar's also helped, or at least a relatively, flat trend line dollar has been somewhat beneficial too. And you've seen a little bit of weakness in countries like Indonesia and the Philippines, where I think the economies are solid and benefiting from that China reopening. So those also look interesting. But overall, emerging markets picking your places has worked quite well this year. And I've been telling our clients, it's all about how you select where you are in the market. Even though markets have been narrow, you can still outperform by diversifying and picking and choosing your spots.
Okay, well, on that optimistic note, we will let you go. Matt Orton, thanks a lot for joining in and speaking to CNBC TV18. Let's take a quick break. On the other side, our entire research team will be with us to help us with the top 10 trades for the day. Stay tuned.